The window of historically low tax rates is closing, with the Tax Cuts and Job Act expiring in 2026. You only have the rest of 2024 and then 2025 to take advantage of key strategies that could potentially save you thousands of taxes before rates go up. I'm sharing with you 13 strategies I'm using with my retired clients to help minimize their taxes, and you can use them too. At the end of this video, I'll share a word of caution, as some of these strategies may do more harm than good if not used properly. Let's dive in. First strategy you may have heard of before, and that's a Roth conversion. When you're taking money from a pre-tax retirement account such as an IRA and proactively taxing yourself by taking money out and then putting it into a Roth IRA, an account where the money will not only grow tax-free but be withdrawn tax-free. This is especially advantageous for those that are going to be forced into a higher tax bracket in the future, either because they haven't started their pension or Social Security benefits, or more likely their RMDs have not yet started, their required minimum distributions. This spike in mandatory withdrawals makes your income often go into the next tax bracket. So, that being the case, why not take out money now, proactively tax it at perhaps 12% if you're in that range, under $94,000 of taxable income if you're married filing jointly. Take that money and put it into a bucket where you can be taxed at 0% forever, rather than being spiked and then being taxed at the next bracket, which is 22% today. Tax Cuts and Jobs Act will bump that back up to 24%. This video is an overview of tax planning strategies, but if you'd like to see a deeper dive of Roth conversions, then subscribe to the channel for a future video about it. The next strategy has to do with pushing or pulling your income. For example, a few clients I met with this week have a large lump sum expense coming up next year. One of them wants to build a large shop on his property. Another client is building out their basement. We're talking tens of thousands of dollars that they need for these projects. And so with both of them, we have the advantage of looking at the entire year of 2024 so far to say we can more accurately know where your taxable income is going to land if we take out certain amounts. So pull income into this year if you know you need a large lump sum anyway next year, as long as you stay within the tax bracket you're targeting. Another strategy is to then push income into next year. This could be applicable if you have a severance package from your retirement and you could push it to the next year. I call this with my clients saddling income across years. So here at the end of 2024, we can take out part of that amount to fill up a tax bracket, and then we can wait till January to take out the remaining amount they need, rather than take it all at once, either this year or next year. The next strategy has to do with harvesting capital losses. Now, if you have an investment in a non-retirement account that has lost value since you put it in, you can sell that and use that loss to counteract against a gain of another investment that you'd like to sell off and withdraw. So thereby perhaps negating the tax liability altogether. Or if you want to harvest more losses beyond that, you can write off up to $3,000 per year against your income as a tax write-off. You do need, however, to make sure that you have sold that asset for 30 days before considering going back into it to make sure you retain that tax benefit. In contrast to harvesting capital losses, which I just mentioned, there's harvesting capital gains instead. This is when you have investments that are gained in value. You can sell those off. And if you're in the 12% federal income tax bracket, that means you're also in the 0% capital gains tax bracket. And you may ask, well, if I don't intend to withdraw the funds, why should I sell off? Well, you can wipe the slate clean of the capital gains inside of that account, rather than waiting a decade or so when you actually need to take a lump sum out and saying, my goodness, look at this big tax liability of a headache I've got going on. I wish I had chipped away and trimmed off some of the fat year by year by harvesting capital gains. The next strategy has to do with Medicare, and that is the Income Related Monthly Adjustment Amount, or IRMA as the acronym goes. What this means is that depending on your income, your Medicare premiums may be bumped up and become more expensive. Your Part B and Part D Medicare premiums. Those thresholds in 2024 are for those that are married filing jointly at $206,000 of income. And if you're filing single, $103,000 of income. Your Medicare premiums today are being affected by what happened 2 years ago. It's a 2-year look back period. In other words, what you do with your taxable income now for the tax year 2024 will affect your Medicare premiums in 2026. So be mindful as you're executing some of these strategies that you don't come back to haunt yourself by spiking up your Medicare premiums in the future. The next strategy is a simple one, but potentially painful if you get it wrong, and that is simply fulfilling your RMD. If you don't fulfill that RMD, you get slapped with not only the taxes, but a 25% penalty on top of that. So one recommendation is to consolidate your pre-tax accounts into one. So if you've got multiple 401k accounts or multiple IRAs and other maybe 403bs, put them all into one IRA so you can more easily track this RMD and not mess it up. And it makes it easier for other elements such as asset allocation, investment strategies, come tax season when you need to manage the tax forms, etc. The next two strategies have to do with optimizing your donations, and the first is qualified charitable distributions, or QCDs. Starting at your age 70 and a half, you're able to donate directly from a pre-tax retirement account, such as an IRA, directly to a charitable organization. This allows you to fulfill a donation that you were going to make anyway without having to pay the taxes on it. This is especially advantageous if you've already started your RMDs. So, if you want to make a donation to, say, your church or another charity, instead of taking the money out, being taxed at income brackets, putting it in your pocket, and then paying cash to the charity, you can just send it from one institution to the other, not having to pay taxes on either end. So, it's a win win situation. You can do up to $100,000 of a donation per year this way. So, significant tax savings potential there. As an important caveat, though, make sure that your tax preparer is aware that you're doing a QCD because conveniently, interestingly, the tax forms don't note that this is a non taxable event. The next tax strategy for donating is having to do with your non retirement accounts. And that has to do with taking stock that's appreciated, grown in value, and donating that to the charitable organization. Doing so allows you to forego having to pay taxes on the capital gains and them as well. It's a win win situation, again. It can be a little tricky to navigate the QCD or donating in kind if you're doing it on your own, but if you have a financial advisor, I suggest you ask them to help you with that. Next strategy also has to do with gifting, but more specifically, the idea of reducing your taxable estate. The Tax Cuts and Jobs Act, again, sunsetting in 2026, will reduce the estate tax exemption amount from $12.2 million down to $5.49 million, adjusted for inflation. So, in short, the exemption amount will be cut in half. So, that's a significant consideration for those who have a sizable estate. One strategy to combat this is to give away some of your money proactively. In 2024, you can gift up to $18,000 per year per recipient. And that's just one way to chip away at the size of your estate rather than having a significant portion of it taxed upon your passing. Speaking of giving money to grandchildren, one common goal of my retired clients is to contribute to their grandchildren's education. And this can be done through a 529 college savings plan. Now, how this helps you with your taxes is most states have a way for you to have state income tax benefits based on those contributions. I'll put a link in the description of this video for you to verify if it's applicable to you. The next strategy has to do with Roth IRAs. Again, if you or your spouse have earned income, consider contributing to a Roth IRA. Because again, you might be in the 12% income tax bracket, but even if you're in the 22% income tax bracket, we already know that those are going to go up to from 12 to 15 and 22 to 24 respectively. And that's about the healthy range. I feel that it's still advantageous to contribute to a Roth IRA, again, depending on your individual situation. But to put money into an account that's never going to be taxed again can be super advantageous. Now, there is income restriction around that benefit, which phases out your eligibility to do so starting at $230,000 of income if you're married filing jointly, or $146,000 of income if you're filing single. On top of making contributions for yourself in a Roth IRA, you can do it for a non-earning spouse as well. So long as the earning spouse's earned income is high enough to cover both spouses' contributions, you can make a contribution on their behalf as well to a Roth IRA. The Roth IRA contribution limit in 2024 is $8,000 per person per year for those over age 50. By the way, you can also make traditional IRA contributions for a non-working spouse as well. The next tip is to check your tax withholding and or estimated taxes. In short, you need to make sure that you've paid enough estimated taxes throughout the year and not leaving a big tax liability to tax season. IRS really doesn't like that, and they may slap you with a big penalty for it. So your next question might be, how do I know if I'm at risk for that? The rule of thumb is you should aim to pay at least 90% of the total tax you owed for the prior year through a combination of the tax withholdings as well as estimated tax payments. However, if your AGI, adjusted gross income, is over $150,000, you should aim to pay at least 110% of last year's taxes just to make sure you're covered. Again, consult your tax professional. Now, a word of warning. Tax planning is not a one-size-fits-all endeavor, and you don't want to trip over dollars just to save pennies on your taxes. So not every tax strategy may be a fit for you, and actually some of them may do more harm than good, especially if you don't execute them correctly. I highly suggest you consult your tax preparer and or financial advisor to make sure that these strategies are A, applicable to you, and B, in your best interest before executing them. If you learned one thing in today's video, feel free to like it so others can find it as well. And you can also subscribe to get deeper dives on some of these topics that I'll be releasing in the future. Comment below to tell me which interested you the most. Thanks for watching. I'll see you in the next one.